To the Trust Officers Association of the Philippines, President Robs Ramos, officers and members of the Trust Officers Association, the Bankers Association President Lorenzo Tan, is he still here? I want to borrow some of his video clips. Speakers and participants to the Philippine Summit on Pension and Investments, my co-workers in government, good morning to all of you. I'm delighted to be here this morning because this is the first time I'm actually being asked to speak about the other side of what running GSIS is all about, and that's the investment of all the premium that we receive from our members. I've spoken to many of my stakeholders, and really what they want to hear is what we've done to reform the pension fund. So it's all about policies and benefits and more loans. So I actually welcome the opportunity to tell you a story about what we did when we inherited GSIS in 2010 and how it's done and what the future for the system would be going forward. So before I do that, I think it's important that I explain what GSIS is all about and what are some of the characteristics of the system. As you all know, in the Philippines we have two different pension systems. I believe President Tiquero spoke yesterday about the private sector pension system. The GSIS actually administers the pension and benefits of now 1.85 million employees and pensioners. That's an increase from the 1.7 million stated by earlier, and that's primarily because of the torrid rate at which the Department of Education has been hiring as a result of the K-12 program. So in 2013 they hired 64,000 more teachers. In 2014, this year, they hired another 46,000. I expect that that would be the same for 2015. So it's possible that by the end of 2016 we could be running a pension fund accountable to 2 million stakeholders. It is a defined contribution system. Defined benefit system, not a defined contribution system. So regardless of the returns that the premiums that accrue for each member, there's a mandate that be returned to them in the form of defined and very formulaic driven benefits. It covers all government employees regardless of employment status. We do not cover the judiciary or the uniformed personnel of the military and the PNP, but we are working with these groups to put in place a pension system that will look after our men in uniform. At the moment, pensions for men in uniform are directly sourced from the budget. So every year when the Department of Defense receives its budget, from there is sourced modernization, from there is sourced wages, but from there is sourced as well the pensions that are to be paid out to the little over 100,000 retired soldiers in the Department of Defense. We provide retirement benefits, separation benefit, unemployment, disability, survivorship, pensions for the reigning spouses, death benefits, as well as life insurance. And this is where President Emil is very jealous. Our contribution rates are 9% for the employee and 12% from the employer. So a combined contribution to the system of about 21%, which is almost double what the contribution to the Social Security system is. Demographics, I already mentioned we have 1.84 million, that's 1.44 million active members in government and 400,000 old age, disability, and survivorship pensioners. And I want to draw your attention to the age of the average government employee. We've heard all about how young the Philippine workforce is, how more than 50% of our people are less than 23 to 25 years old. The workforce in government is actually much older than that. I think the average age of a government employee is about 44, 45 years. So we are getting close to when a bulk of these active public servants will move on into retirement. The actuarial life of the fund is currently 2048. And the way I try to explain to my members when I see them what that actually means, I tell them that that's not something to be worried about, because the average age of a government employee is 45. And the average life expectancy of a Filipino is about 72 or 73. And the female Filipino is 74, 75, and the male lives much shorter, about 70. If you're average 45 and you live on until 72, 73, that means that the fund should be about 28 to 29 years to go. And since most people marry around their same age group, if you do go ahead of your spouse, then there will be an additional number of years that should be left in the fund to pay for survivorship benefit. So that if you add 29, and then if you look at just averages, as long as you have 3 or 4 years left after that, then that should be more than sufficient. And this is closed group valuation. We're talking about what would happen to the GSIS if every person who were to retire were not to be replaced. So the government becomes more and more efficient. So sometime in 2042 or 2043, when the last person in government leaves and shuts out the light, we'll still be there to pay him his pension until he reaches the actuarially determined lifespan, and there might be some left if he has a surviving spouse, provided that he didn't marry someone who was 10 or 15 younger than him or her. We also are suffering from a declining support ratio. In 2013 and 2003, the support ratio, which is the number of people who are working supporting the number of people already living on retirement, that ratio used to be about 10. 10 years later, 2013, that number has declined to 5. And since the government actually has been pretty static in terms of the workforce, at somewhere around 1.3 for over that decade, we expect that this trend of a declining support ratio will continue, placing a greater burden or greater need for the pension fund in order for it to meet its liabilities to its pensioners. So that's the stakeholder group that we minister to. Last year, for the first time in its history, we actually paid out more in benefits than what we took in premiums. But that was we refer to that as crossover. That was a technical one. All our projections had us actually hitting that crossover in 2014, but we were surprised that happened last year. But it's really because in 2013, the government allowed many of the agencies to undertake a rationalization program. So normally GSIS sees about 30 to 35,000 retirees a year. At the end of 2014, when we tallied the applications for retirement, we hit 50,000. So we had a surge of nearly 40% more retirees last year than what we normally saw, which resulted in breaching that crossover where we actually paid out more than what we received in pensions. What that really means is that people who normally have retired in 2015 or 2014 and 2016 took advantage of an early retirement program. And so I expect that what we paid out last year should decrease a little bit year over year, but sometime soon we will eventually make that first crossover. And what that means is that increasingly the benefits that we pay out must rely on the investment returns that the GSIS generates from the assets that it manages. So that's GSIS and its members. What do we do in 2010 with what we received? First of all, we looked at the fund, we looked at our members, and we decided that we would talk to our Board of Trustees and agree with them on the set of parameters by which GSIS would invest. We looked at our charter, and it said very specifically there that GSIS investments must meet the conditions of liquidity, safety, and yield. That's Section 36 of Republic Act 8291, which is the GSIS charter. So we sat down with them and agreed on an investment policy guideline, which was there to enhance and provide the framework for the GSIS to carry out its fiduciary responsibility in a transparent and accountable manner, and to serve as a guide to promote the safety of the funds. It was also designed to optimize the returns on its investments and ensure the requirements for liquidity. Warren Buffett stole what I was going to say, but as a result of that, we no longer invest in paintings. In fact, the GSIS collection is now resident in the National Museum on loan. And at some stage, it would be right to liquefy our painting collection. But I've noticed that paintings generally rise in value, but and it's very well correlated with the rising economic affluence of a country, because the country's painter's biggest collectors are people from the country that he's in. And when our economy continues to generate the kind of growth that includes more into that rising middle class, I have no doubt that these paintings, which are currently on display in the National, will be worth a fortune. But is it for GSIS? I don't think it satisfies the liquidity requirement. Liquidity means that when you need to sell, there's a market that you can sell to. For art, the market is what somebody is prepared to buy. So we believe that art is best left to collectors as opposed to a pension fund. We formulated an investment policy that would empower management to evaluate investment securities, fixed income, equities, mutual funds. The idea is that if we need to create the capacity internally in GSIS to be able to evaluate suitable investment opportunities for the funds that we have a fiduciary responsibility for. We also asked the board to overhaul its foreign exchange hedging policy. When we arrived there, the policy was that we could not hedge more than 50% of our foreign exchange exposure. And this was based on a belief that the peso or the dollar peso was a one-way bet. We didn't hedge it because we thought that the dollar was going to go down. We just wanted to make sure that when we took an investment in a foreign exchange denominated asset, that we're going to make money because of the asset rather than taking a side bet on the currency. So we actually also extended how we hedged our foreign exchange exposure and to extend the tenor. That way being able to lock in very attractive premium rates of as much as 220, 230 basis points back in 2010. We also decided that we would stop direct institutional lending because we didn't have the capability to correctly assess credit risk. So in 2010, putting all that into maybe a philosophy or an approach, what we did was we embraced what I call a liability-driven investment approach. We focus on the rate of growth of our liabilities as well as the duration of our liabilities. That figure was not available when I arrived on the scene. I finally got the number of what the duration of the GSIS liabilities was sometime in November. It was about 14 years. And the aggregate hurdle that we needed to grow our existing assets to be able to meet the liabilities of our total liabilities was somewhere around 9%. At that time, and it seems like a long time ago, but in 2010, government bonds were still yielding 8.25%. Right now, it's close to half that. And then we also took a fateful decision to bring back the money that we had invested overseas. In 2008, probably the worst time in investment history, the GSIS decided to deploy internationally through what was called the Global Investment Program. At that time in 2010, when we were reviewing the investment landscape, there was just very strong uncertainty about what was going on in the internal environment, and we decided to convince the Board of Trustees that it's time to bring the money home. And so in March of 2011, we gave notice to our 2 external fund managers that we were going to be redeeming in the first quarter of 2011. Actually, sorry, going back and forth, I just forgot. I remember when we actually, when I joined in 2010 March, the previous management had already identified another 2 international fund managers that it was going to deploy to. And that would have taken the total investment portfolio of the GSIS in international assets to about 10% of its total asset base. We were supposed to deploy another $400 million, $200 million each to 2 international fund managers. And they were actually waiting for the check to be signed. And I just couldn't bring myself to sign those 2 checks, because it was also simultaneous to the time when our president was for the first time going to the United States. And I remember him saying that he was there to try to raise money and he'd be happy if he could come back with $500 million. So I just could see the headline, and that would have been the shortest lived presidency of the United States had I written those 2 checks. So I went to the chairman saying, is there any way we can hold off on this? And he was sharing similar sentiment that we could not possibly do this at this time. And in the end, we agreed that perhaps this was not the time to add to our foreign exposure. And in fact, the sequence was later on we decided that the outlook was just a bit too uncertain, whereas in the Philippines the visibility was slightly better, and so we pulled back all these assets that we had invested overseas and deployed them in the local market in 2010. We also increased the allocation of the fund in fixed income. And in particular, we lengthened the duration of the portfolio. For a pension fund with a liability duration of 14 years, it seemed odd that only 11% of the fund's investable portfolio were in bonds over 15 years. The bulk of it was in the 0 to 5 year space. So we were very lucky. In the 4th quarter of 2010, the Treasury embarked on a maturity lengthening exercise. We used that opportunity to really lengthen the duration of our portfolio by tendering a lot of our short-dated bonds, and I mean a lot, and rolling that into 25-year bonds yielding 8 1/8. We were so big in that tender in December. We were 40% of the tender and 30% of the new bonds that were issued, that I had the Treasurer of the Philippines come to see me the next day because he wanted to know who I was. And I invited him upstairs to lunch, and as we got to know each other, I said, you know, this is a big difference between the private sector and the public sector. Because in the private sector, when you become an elephant in an offering, it's the bankers that come in and take you out to lunch. In government, GSIS saved the government 1/8%, and I was buying the treasurer lunch. What else did we do? We increased our allocation to equities. My predecessor had sold a lot of the GSIS core holdings and forgot to reinvest it in the market. Our equity portfolio in the domestic market was no more than 4% of our total equity exposure. And this was in 2010 when the market was up something like 44%. So we did not participate as fully as we could have had we had a reasonable exposure to equities that year. We took advantage of the rather weak-ish market in 2011 to build up our equity portfolio. But we avoided having lumpy positions with huge concentrations. In fact, we put in our investment policy guidelines that GSIS will be allowed to invest up to 20% in the domestic equity market, but it will also observe a limit in terms of individual equity exposure, so that if we actually bought enough to qualify for a board seat, we would only do so if the board approved that, that acquisition, that purchase. So we do not really have very concentrated bets in various listed equities. It's a very well diversified portfolio, and what we do is we do sector under and overweightings to position the portfolio if we think that certain stocks will outperform others. At the moment, we have now 17% of the total portfolio, and while it has quadrupled from what it was in 2010, the assets of the GSIS have also doubled over that 4-year period. So it's a significant exposure. It is currently about $3.5 billion worth of exposure in equities. And we've also increased the amount of money that we allocate to local fund managers. We are not proud if we find that there are well-performing portfolio managers with a demonstrable track record, then we will allocate money to them, because we need to be able to give money to the ones who can best invest it for the benefit of our members. And then we started thinking, now that we sort of rebalance our portfolio, let's talk about diversification. And the first diversification that we did was by going and exploring infrastructure investment. And we began this process in 2011, where we sent out invitations to the good and the great, the 10 largest international infrastructure investors. They all, I think 5 or 6 responded. They submitted their proposals. We asked them to present to the group, and we knew that while we may know something about infrastructure, it was best to have experts with us. So we also invited the Asian Development Bank as well as the International Financial Corporation to be part of the panel, and hopefully be part of the investment that would be made in it. And after 6 or 7 months of listening to the presentations and cutting it down to a short list, we decided that the manager would be given the opportunity to run the portfolio that we would put up to invest primarily in core infrastructure in the Philippines would be Macquarie, who has a long history of investing in infrastructure. I think, in fact, that Macquarie probably defined the space if you look at the 1990s to see who were the pioneers of buying income-producing assets and packaging them into securities that the public could buy. We like infrastructure because it shares many of the same characteristics of bonds. It's the tolls, the charges that a investment in core infrastructure generate results in a steady stream of cash flows, as well as the real nature of these assets provides you some kind of a hedge against rising inflation. And in 2011, I have to say that I was wrong, but I was very concerned about inflation, primarily because rates were getting too low, and was I wrong there, because rates are even lower now. And money supply was growing at such a fast rate that it looked like having an investment which was like fixed income, but which had a protection against inflation, was the right way to diversify the portfolio. PINAI, as we called it, Philippine Investment Alliance for Infrastructure, was launched in July of 2012 with $625 million US, $400 million from the GSIS, and another 225 from 3 other international institutions. And as of the half-year mark, they had already invested half of the money that we'd given them. I'd expected that they would have invested all of it already by now, but there's been a little bit of a delay in some of the large infrastructure projects that the government is trying to put in place. So in fact, I've already told them, okay, continue to look at the government projects, but also look at some of the private initiatives in core infrastructure to see if we could partner with these proponents to be able to invest the fund. Because the idea was that this was not supposed to be a one-off fund. This was supposed to be the start of a series of investments in infrastructure. I think the last estimate was we need something like 40 or 50 billion of infrastructure for the economy to generate the kind of inclusive growth that we need to pull more of our people out of poverty. So even 625 million, which at that time was already the biggest fund in infrastructure raised for the Philippines alone, it was just a drop in the bucket. But I think it goes to show just how difficult it is to deploy money, given that it's already been nearly 3 years since we, actually 2.5 years since we allocated the funds, and we're only halfway there in terms of actual investment. And then, of course, we opportunistically look at ways that we can, while we invest, we also look at opportunistic ways to take profit or realize gains. So we thought that the real estate market was getting a bit frothy, and late last year we disposed of a property we had in Ortigas, and then more recently we conducted a public bidding on our properties in the Fort Bonifacio district, and I was just stunned when I saw what price people were paid to pay per square meter in Fort Bonifacio. The 2 properties that we bidded out, one went for, the recent sale was less than 300,000 pesos per square meter. We were able to realize a price of nearly 460,000 for one of our properties, and a staggering 500,000 pesos, which is more than what Ayala was going for in Fort Bonifacio for our other property. And I think the market is really white hot, so we're going to see if we can schedule maybe yet another bidding before the year is out for some of our other larger pieces of land in the GSIS portfolio. And the idea is to turn these idle assets into income-producing assets. So there's a lot of fundraising going on right now. Banks raising LTCDs, corporates doing preferred shares. So, getting 6% or 5% on an investment from property that was yielding 0, especially after you've realized a huge capital gain, I think is a very good way to continue to enhance the total return that we're getting from our funds. One way to generate returns for a pension fund is to focus on investments. Another way, of course, is to make sure that you plug the leaks and make sure that you actually don't lose money. So another thing that we did in 2011 was to exit from the GSIS home lending program. For many, many years, GSIS ran a loan program which allowed government employees to borrow for their homes against their contributions in the fund. And while the experience of the GSIS may be in the 40s and 50s in this program was very good, the more recent experience has been pretty awful. GSIS currently sits on something like 25,000 foreclosed home units, and there's probably another 25,000 foreclosable units that we will have to take over and find a way to monetize. We looked at the comparable statistics in terms of home lending to some of the key shelter agencies that were established maybe in the last 20 years. And while in 2010, for example, GSIS lent about ₱500 million to 500 borrowers in government. I talked to the president of Pag-ibig and asked her, how much did you lend to public sector employees in the comparable period? And they lent 11 billion to 10,000 members. So they were doing almost 10 times what we were doing, lending to the same group of people. So rather than GSIS continuing with this program and losing money, we decided that we would just lend money to Pag-ibig and let them do the lending, since they seem to be much better at it. And that way we can focus on what we do best, which is running pensions and hopefully investing the money for a good return. Now, since then, because of ample liquidity, Pag-ibig has repaid us the loan. But in the first year, they were able to match what they did in the prior year and lend that to 10,000 of our government employees. So I told the president of Pag-ibig that when the time comes and maybe funding is an issue, we're happy to offer them again the same facility, so that it doesn't look like we are turning our back on the housing aspirations of government employees. It was a deeply unpopular decision at that time. I had public school teachers protesting outside my gate saying, why are you turning your back on a key benefit that we've enjoyed for many, many decades? But when I explained to them that when we lend to you for housing and you don't pay back, we lose money 3 times. First, we don't get the interest on the money we lent you. 2, we don't get the money back. And then 3, when we take over your home, I have to spend money to secure it, look after it, and then find a way to sell it out and liquefy the funds. And when they sort of understood that that was the effect of a poor housing program, and also reminded them that, you know, when the GSIS housing programs put in place back in the 40s and 50s, there was no Pag-ibig, there was no HDMF, there was no key shelter agency. It's really best that the government, with its scarce resources, specialize so that each agency is able to best perform the task that it has to do. The other one was, we had about 315 suspended agencies who were not remitting premiums to the GSIS. So we sat down with them, reconciled, offered generous terms for them to be able to restructure and continue to pay their arrears. We've now been able to reduce that number from 315 over the last 4 years to something like 102. So we're averaging at about a memorandum of agreement a week. The landmark one was the tripartite signed with the DBM and the Department of Education in September of 2012, where the DBM acknowledged the liabilities and the arrears of the Department of Education and committed to pay the GSIS for the 13 years over which we did the reconciliation up to 2010. And that money has been paid, and that has been added to the coffers of GSIS. So by not just focusing on the investment side, but by also increasing the efficiency of collection, as well as cutting out poor programs or poor investments. We've been able to transform the portfolio of the GSIS into something which is generating the 9+% return that we need to ensure its sustainability. So, despite the challenge of attaining that delicate balance, and this is what I always tell our stakeholders, you know, we could be popular, we could give you everything you ask for, but the responsibility of GSIS board and management is to balance the needs of the current crop of government employees with the future generation of government employees. And if we are irresponsible in how we dispense the benefits and not take into account that next generation, then the entire government and the country will be poorer for it. So we have to make sure that we strive to get a good balance between the benefits that we pay for this generation, because we have to ensure the viability of the fund for the future generation of government employees. Given our aging public sector workforce and the crossover I described earlier of claims over contributions, which is imminent, we need to generate sufficient investment returns to secure the GSIS sustainability. I believe that the GSIS is up to the task, given its robust investment philosophy that enables us to explore other asset classes for increased returns. We will continue to look at ways that we can bring in expertise in other asset classes into the GSIS portfolio. At the moment, local fund managers are managing 1/3 of, about 25% of our total exposure in equities. I'd like to see that that proportion rise to maybe 50%. So we will continue to look at the performance and the track record of many of our trust departments and mutual fund managers, because we're getting too big internally to continue to invest in the market without having market impact. So we've gone from 3 managing 6 billion to 8 managing about 25 billion. There's no reason why that can't double again, managing 50 billion in the next 2 to 3 years. But we're always looking for ways to add to our returns, because at the end of the day, that's what ensures the sustainability of the fund. GSIS is in a strong position, given that we do have adequate assets right now to meet our actuarial liabilities, but yields at 3.5% and 4% is making that task more and more challenging. And so we are going to continue to explore other ways by which we can continue to meet the return hurdles that we need to ensure that we have an actuarial surplus in our funds. Thank you very much, and I hope you have a fruitful session.